What's happening, everybody? Welcome to another episode of Real Estate with Gav. I'm your host, Gavin Washington, aka Gav the Realtor. And today we got another special guest with us, someone that's been pretty much an extended part of my family for a really long time, lender, Miss Heather Adams. How you doing today?
I'm doing well. How are you?
Doing pretty good. So for those that don't know, Miss Heather and I go
Way back.
So my broker is actually Miss Heather's husband, and he was my soccer coach growing up for a long time, and he likes to take credit for everything I'm doing now, and even my soccer time. But Miss Heather was the kind of the behind the scenes that discovered that, right?
Absolutely.
Yeah.
I do like to tell this story and take credit for it.
Yeah, tell us a little bit about how that started.
So Gavin was probably 7 at the time, I think, and it was the U8 draft for Berkeley County Rec League Soccer, and him and Cody were the two standouts, and Tracy had the first pick in the draft and was going back and forth, and he said, "Who do you think I should pick?" And I was the pseudo assistant coach at the time. And I said, "Oh, no question, Gavin, by far." And he did end up taking Gavin first. And the rest is history.
And the rest is history. Yeah, and we kind of stuck together ever since then. And now it's full circle. We're all working together.
Absolutely.
So, yeah, definitely appreciate everything you guys have done, from childhood till now. So definitely glad to have you on. And
well, you made it easy.
Yeah, for sure. Yeah, this is going to be a fun one for sure. So tell us just a little bit about yourself and your journey to becoming a lender.
So back in, I want to say 2011, I started as a real estate agent.
Okay.
And I worked with Tracy, my husband, at Weikert. In 2015, he bought the brokerage and became the broker. And I worked as an agent from 2015 until end of 2019.
Okay.
And about the end of 2019, I was doing a lot of running and was missing some of my kids' events, soccer games, horse shows, for having to go show houses.
Right.
And for me, my family is absolutely the most important thing to me. And I really didn't like that I was missing out on things. So I made the decision then that I was going to switch to something different. But I wanted to stay in real estate. I wanted to stay a part of that process because I enjoyed it so much. I enjoyed working with people. I enjoyed helping them through one of the biggest events in their life.
Right.
For a lot of people. And so, I thought about it and I thought, well, I could become an appraiser or I could, do home inspections or become a lender. And I made the decision to look into becoming a lender. And once I made the decision, it went pretty quick after that.
Okay.
Took the test, or studied, took the class, took the test, and the rest is where we are.
There we go. Now we're working together in a different capacity.
Absolutely.
So tell me a little bit about Revolution Mortgage. That's where you work, right?
It is.
And you kind of started with one company, and it looks like your company grew into something else. So tell us a little bit about that.
So when I first got into lending, I made the decision to go work at Gold Star Mortgage with Jake Gregory and his team. At the time, it was Jake, his loan assistant, Sonia, his wife, Chelsea, who was our do everything, and then myself. And we've steadily grown various branches. During COVID, we were getting priced out a lot on loans where our rates were higher than our competition. So we made the decision at that time to move to Loan Depot. And we were with Loan Depot for 2.5 years. And then there were some changes coming that didn't look the best for Loan Depot, so we made the decision to move to a smaller company. It's a nationwide company, Revolution Mortgage. They have a lot more products in-house and a lot more products that we can broker out. That made the decision pretty easy for us. I have, our branch does a lot for our borrowers, and we're like a family. So I can't imagine working with a different group of people.
Right. Okay.
So no matter where we go, we're all together.
That's good. That's good. Well, we're going to dive into a little bit about those programs and options and things that you guys can offer, because there's some different things I don't think a lot of buyers out there know about. So first, before we get into that though, let's talk about pre-approval and pre-qualification. What's that process look like, and what is the difference between pre-approval and pre-qualification? Because I think people get those terms mixed up.
A lot of times people use those interchangeably,
Right.
and there really is a distinct differentiation between the two terms. Pre-qualification is more when you kind of take the buyer at their word, and you may pull credit, you may run their file through an automated underwriting system, and that is your pre-qualification.
Got you.
Pre-approval goes into a lot more detail where you have collected documents, you've reviewed income documents, you've reviewed asset statements, you've kind of looked through all the documents involved in initially getting a file to approval and determined that it meets the requirements for the loan program, and that's where you get a pre-approval. Credit will
Gotcha.
also be pulled. It'll be run through an automated underwriting system.
Okay.
And there's a third, and I'm going to kind of tie into
Okay.
one of your next
Go ahead.
questions.
Let me hear it.
But there's a third type of approval, which is underwriting approved.
Okay.
And that is where you submit your borrower before they are under contract on a property, but you have all of their documentation. You submit it to underwriting, and you get an underwriting, or what we call a TBD approval. And what that does is that assures a seller that your buyers are good to go.
Gotcha.
It's almost the next best thing to having a cash offer.
Gotcha.
At that point, we know what the conditions are for the loan approval. We're just pretty much waiting on title and appraisal at that point and getting those conditions cleared.
Okay. So pre-approval is a little bit more detailed than like your pre-qualification. You're doing a little
Absolutely.
bit more of the financial history. But you can, as you mentioned, you can go deeper into the full underwriting process and have a buyer pretty much all the way ready to go
Correct.
to closing. And all you need is, appraisal and title.
Yep, and to take care of the last, the conditions that the underwriter has indicated that they need. But at that point, you're relatively certain that there aren't going to be any major surprises.
Yeah.
Now, you do still have those instances where buyers do silly things
Of course.
and don't listen.
Been there.
And, there's always something that can happen
Right.
at the end. But in general, it's, another layer of assurance that the file is good to go.
Gotcha. So that full underwriting process, is that something that a buyer would typically request, or would you kind of look at a buyer and say, hey, this might be like a good option for us?
We try to any buyer that we can get pre-approved, we try to get them into underwriting approval as well.
Gotcha. Okay.
Just as a general rule. Now, not all lenders do have upfront underwriting.
Right.
So
Yeah, and that's why I wanted to ask about that, because I know a lot of people don't know that's an option. And like you said, some other lenders may or may not have that. So that's something good to know, because typically I think once you get to that full underwriting process, I think I've seen you close in like 2 weeks.
probably about 3.
Okay, 2
We
or
can
3
usually
weeks.
get things done. A lot of it depends on how quickly we get title work back and how
Right.
quickly we can get the appraisal back.
Gotcha.
Our systems in house are pretty honed in to where we can get things done quickly. We just sometimes have to wait on other people.
Gotcha. Okay. And that sounds more key to a buyer as well, because especially in, the current market, multiple offers and things like that, if you can close sooner, might look better.
Absolutely.
Might look like a stronger offer.
Oh, absolutely. And that's one of the things I do as well, is that if a buyer is underwriting approved and even pre-approved, I will call the listing agent and let them know, hey, this is a good buyer. They're ready to go. We've got all their documents in. Should be a quick, painless, hopefully, process.
Good to know. Good to know. So I got a quick question.
Yes, sir.
On the news, you keep hearing a lot about, things that are happening with mortgages and credit and all that stuff.
And on TikTok.
Yeah, that too. All of it. So, one thing that I keep hearing about, and buyers sometimes even ask me about, is this 40-year mortgage thing. Is that an actual thing?
Okay, so there are very few lenders out there. It is very, very hard to find a lender that will do a 40-year purchase. I don't know that I've come across really any. There are I have heard, though, that there are some that will do a 40-year mortgage.
Okay.
However, what they're mostly referencing is that FHA recently announced that they will allow buyers that are experiencing financial hardship to modify their current mortgage into a 40-year
Oh, okay.
mortgage. So effectively lowering their payment.
Gotcha.
Now, that is something that a borrower, they will want to reach out to their servicer,
Okay.
and their servicer will help guide them through the process and what all that entails.
Okay. So with that, how about PMI? I've also seen some things, again, news, TikTok, all that good stuff. It looks like maybe with FHA borrowers that they are looking to reduce their PMI.
They did.
So that's
They
a thing
did
now as well.
reduce the monthly mortgage insurance
So what's
premium.
that look like now?
It is definitely, it has definitely been a benefit to borrowers.
Okay.
It reduces the amount monthly that they pay on their mortgage. And what that does is it reduces their debt to income ratio.
Okay.
So where somebody might have been able to only borrow a certain amount of money, it'll increase it a little bit. Not a lot, but it does give, if somebody is on the line of being able to get into a home, it may allow them to do that.
Okay. And then one other thing that's been prevalent on the news and social media is this adjustment of credit scores. And yeah, so I
Yes.
definitely need to hear that because it's
Okay.
so what people are hearing or what people are saying is, oh, people with higher credit scores are paying for people with lower credit scores and
That's
things like that.
not quite
Yeah,
accurate.
so please,
And-
thank you. Please explain that, please.
So, and you're probably also hearing that one of the things that I've heard is that people with lower credit scores are getting better terms than people with higher credit scores.
Right.
And people are saying, oh, I'm just going to tank my credit so I can get a better deal. Please
Yeah,
do not
don't-
tank your credit.
yeah.
Please do not
Don't
tank
do
your
that.
credit.
Yeah, so please explain.
Okay, I'm going to
how-
refer to my notes a little bit
Okay,
here.
go ahead. Yeah, we definitely need to hear about this.
So what it did, on any loan, any rate, you have what are called loan level pricing adjustments.
Okay.
These are adjustments to your rate that are based on your debt to income ratio. They're based on the type of transaction, whether it be a purchase, refinance, cash out refi, the type of property, whether it's a primary residence, an investment property, second home, and your credit score,
Gotcha.
and the amount that you're putting down.
Okay.
So your loan to value. And so for each of those, you have a certain adjustment to the rate based on those factors. So what the changes did was, and it predominantly affected people with lower scores and lower down payment.
Okay.
And it affected people with higher scores and then kind of the mid-range.
Okay.
The mid-range down payment. So, for example, if I'm looking at my sheet, the loan level pricing adjustment for people from like a 720 credit score up to a 760, their loan level pricing adjustment, or LLPA, it went up. And then adjustments for people with, say, a 640 to 659, but putting 3 to 5% down, theirs went down.
Okay.
And what they're trying to do is make it a little bit more affordable for people in those lower price points and lower credit scores to be able to afford a home.
Got you.
It's not, people are saying, oh, well, there's no subsidizing going on. It's just trying to bridge the gap and make it more easily accessible for people to buy a home.
Got you.
And they actually added to the tiers used to stop at a 740 credit score, and they added to where it goes up to a 780 now.
Okay.
So you'll see different tiers and different
Got you.
breakdowns.
Okay.
So, for example, what I meant to say was
Yeah, go ahead.
people with lower credit scores are absolutely not paying less in LLPAs and are not getting better rates
Okay.
than somebody with a higher credit score.
Gotcha, yeah.
That is absolutely patently false.
Okay, because that's what everybody is. That's what we keep hearing is all the people with good credit are like, why am I paying for?
No, somebody with good credit and a good down payment is still getting a better rate than somebody with lower credit and less of a down payment.
Okay, good to know.
And that's what people need to realize is that that's not going to change.
Mm-hmm.
There's just less of a penalty to the lower scored, lower down payment
Gotcha.
buyers. That penalty just decreased.
Gotcha. Okay, that makes sense. That makes sense. But
So
yeah, I'm glad you cleared it up because a lot of people think
I
my
see,
my
pe-
my good credit is paying for somebody's bad
and
credit.
it's not. It's really not.
Okay. Well, speaking of credit, one thing that I get a lot sometimes with more apprehensive buyers or people that may know that their credit's not in the best shape at the time, they're like, I'm looking into buying a house and I want to kind of shop around, but the lender's going to have to pull my credit.
Correct.
Can we do they have to pull my credit? But you have something that may not have to do like a full pull, but
We
kind of what we
do.
call a soft pull.
We do have options to do what we call a soft pull. So a hard
Yeah.
pull is where we pull from all three credit bureaus and we
Hmm.
pull a mortgage score. And that does impact your credit. And something that people don't realize that when you have a mortgage pull, it's not the same as when you go to a car dealership and they farm your loan out
Right.
to a bunch of different creditors,
Hmm.
and it tanks your score, what, 15, 20 points
Hmm.
sometimes. A mortgage pull is typically only, for decent credit, 1 to 3 points,
Okay.
maybe. But we do have the option as well to do a soft pull. And what a
Okay.
soft pull is it does not affect your credit at all. And
Good.
we pull from two credit bureaus.
Okay.
And so we don't have the full picture, but we have enough of a picture to know, okay, this person should be good to go, or this person needs a little bit of work. And then
Hmm.
we can work on, getting a plan in place for that borrower.
I like that.
I don't like to tell people no.
Hmm.
Especially people that are, not sure about the process and not sure where their credit is. I will do everything that I can, or even if they know that their
Right.
credit is bad,
Yeah.
I will do everything that I can to at least get that soft pull in so that I can come up with a plan for them.
Yeah.
People think that their situation is hopeless. And oftentimes I go in there and I say, if you do X, Y, and Z, you're looking at 3, 6, 9 months down the
Yeah.
road. You'll be able to buy a house.
Right.
And I think people don't realize that the situation that they get themselves into is not the end of, it's not the end. They can
Yeah.
get out of it.
Yeah.
They just need somebody to tell them how to do it.
That's good. That's good because I get a lot of clients, especially in our community, that are scared to start the home buying process because they think their credit is bad, or sometimes they even know that their credit is pretty bad, and they don't know what steps to take to fix it or get
Right.
it to the point that's comfortable for them. So it's good to know that we can talk about a possible soft pull that can then provide them with information on how to get it up.
Oh, absolutely. And I will work with credit specialists as well if it's something that looks like it's going to be a little bit more complex or will
Hmm.
take a little bit of time. But for most people, it's pretty simple.
Good.
If they reduce, their overall balances on their credit cards,
Hmm.
you'd be surprised what that does to your credit score.
Nice, nice. Well, good to know. So definitely listen to that, folks, especially if you're looking to buy a home soon, looking to get your credit up. Check into a lender like Miss Heather that might be able to give you a soft review of your credit and provide you with some good feedback on how to get your credit up.
And remember that not now does not mean never.
Exactly. Exactly. That's why I think it's important that pre-approval, pre-qualification underwriting process is important because it gives you a review of where you are, but it also gives you a review of where you can be.
Absolutely.
So that's a good point that you can see where you're at, and then like you said, maybe it's 3 months, 6 months, 9 months from now, if you do X, Y, and Z, your credit might look like this, and then you're able to buy a home.
Absolutely. And I've got people that they make a couple quick changes and within 30, 60 days, they're ready to go.
Exactly, exactly. So let's dive into a couple of these programs that you have been working with at Revolution.
Absolutely.
One thing, I think I have a client that's working with you guys right now, actually, is the one-time construction loan.
Yes.
I kind of like that, and it looks like a good option for buyers that want to build their own house, but they're not maybe buying in a subdivision.
Correct.
Maybe they're looking to get a piece of land and then build a house, but you can do it all in one. So kind of talk
All in
about
one.
that.
Okay, so typically in the past, what has happened for construction loans like that
Hmm.
is that you would have two closings. You would have a closing at the beginning, and then you would make interest-only payments throughout the construction process, and then you would have a another closing at the end where everything was wrapped in together.
Okay.
And that resulted in risk to the builder because during that construction period, sometimes borrowers make bad decisions
Hmm.
and they do things that affect their credit or their job and they no longer qualify.
Right.
And then the builder is at the end
Yeah.
stuck and
Yeah.
can't get what they need for the property.
Hmm.
So what this does is this minimizes that risk, and it also reduces the expense to the buyer as they're not going through two closings. So what it is we factor in the cost of the land, the cost of construction with
Hmm.
contingency reserves and all of those fees, and it goes into one closing.
Gotcha.
Those closings typically take about 60 days,
Okay.
but then once that's done, there is no additional closing. Now the loan will be reworked at the end
Hmm.
to make sure that the final loan is where it needs to be
Gotcha.
because things can change. They may add more.
Right. Yeah. Yeah.
We may not use as much of the reserve, so at the end it gets adjusted.
Okay.
And during the construction period, I believe they do pay interest only,
Okay.
and but it reduces again the risk to the builder and
Right.
to
So the builder gets paid up front.
there will be draws,
Okay. Gotcha.
but they will be handled through Revolution Mortgage and not through another party.
Okay.
In the past, with one-time closed construction, we've had to broker that out, and so we lose a little bit of that oversight and I don't want to say control, but
Right.
oversight
Right.
of the process.
Gotcha.
And it'll all be in-house now.
Good, good. Yeah, so in-house is nice too because you know who to talk to, where to go, that
Exactly.
kind of thing. With that, does the buyer need to have some type of plans or a builder or anything in place before they go purchase the land to do all this?
Yes, they
Okay.
will need. They will want to talk to a builder. They will want to have some plans drawn up
Okay.
and have an idea of the costs associated with
Gotcha.
it. Now, the nice thing about our one-time closed construction plan is that it goes with any loan program.
Okay.
So USDA, 0 down.
Mm,
FHA, 3.5% down.
wow.
VA, 0
Zero
down.
down. Yeah.
Conventional, up to what they want to do.
Yeah. Yeah. That's even better. That's even
So
better.
when you have borrowers that may not, have the 20% to put down, this gives them
Yeah.
an option.
Okay. Well, I might be calling you on that soon.
Well, what'll happen if you go anywhere else.
Well, let's talk about the FHA 203K or rehab loan. I'm starting to see that a little bit more and a possible viable option
It
for
is.
buyers that may be looking at lower income properties that
And
might need a little bit of work.
I think this is a really underutilized option
Okay.
in our market, and I'll tell
Mhm.
you why.
Okay.
A lot of loan officers don't like, and I know this from personal experience as a realtor,
Mhm.
a lot of loan officers do not like to deal with 203K loans because they can be a little bit more difficult.
Mm.
Right now, with interest rates where they are and housing prices where they are, a lot of borrowers are just simply priced out of this market. But if they can get into something maybe a little less expensive because it needs repairs,
Mhm.
you might see more people being able to get into homes. So I think in that respect, it's a little bit underutilized. But
Mhm.
basically, they depending on the and there are more renovation loan types than just FHA. There's
Gotcha.
a home style through Fannie Mae as well, so a
Okay.
conventional loan. And depending on the type of renovation loan and the extent of the repairs, you have a consultant or a contractor go out, write up a quote, and the purchase and the repairs are financed into into the mortgage.
Gotcha. Okay.
Now, if the house is habitable, they can live there. Usually takes about 60 days to close. If the house is not habitable for certain loan programs,
Mm-hmm.
you can also finance up to 6 months of principal and interest,
Gotcha.
taxes and insurance. So
Okay.
6 months of mortgage payments.
So do you have to get approved for more in order to be able to do a rehab loan? Because obviously you got to pay for the cost of the
Well,
rehab.
hopefully you have a good loan officer that has looked at the whole picture
Mm-hmm.
and can say, okay, this is what you would be pre-qualified for if, or pre-approved for if you were purchasing, ready to go house.
Right.
And here's kind of what it would look like as a renovation loan. These are things you need to, think
Yes.
of. But you do want to have an idea. I always recommend that if people are looking to go the renovation route, that on one of their showing appointments, that they do take a contractor with them to
Okay.
get a rough idea
Mm-hmm.
of what the repairs are going to look like.
Okay.
Now, something that people need to be cognizant of is
Mm-hmm.
that they will have to hire a contractor to do the work.
Right. They can't do the work themselves. Gotcha. Which makes sense because, you guys are funding it. You want to make sure the right people or the right team are taking care of the job. So that
And
definitely
sometimes
makes
Harry
sense.
homeowner doesn't do the best work.
Yeah, no, I get that. I get that. I think that is good to know though, because so me personally, for instance, I have a couple of buyers that I'm working with right now that are looking in that 200,000 price range. Well, as we all know now, 200,000 doesn't get you what it used to get you back in the day. So it's kind of hard helping those, but especially the ones that say I don't really want a townhouse, because I mean even townhouses are 250 now.
They are.
Or up to 300 for some of the new ones. So in that price range, it's finding difficult for FHA, USDA buyers because the appraisal won't pass some of those older homes
Correct.
that need some work. So if they're looking to look in that price range, a rehab loan might be something that they want to discuss with their lender.
Absolutely.
Yeah, for
Absolutely.
sure. Good to know. Tell me a little bit about the West Virginia Housing Development Fund and how that works.
Okay, so West Virginia Housing Development Fund is another option that we have, and they offer a number of programs that they can go FHA, USDA,
Mm-hmm.
Conventional, or VA.
Okay.
If you go through the West Virginia Housing Development Fund, it's only obviously for properties in West Virginia, but they do offer a very nice interest rate of around 5.3%.
Okay. That's nice.
And in addition to that, if you do that, go through their program. Now, they do have income limits. They do have housing limits.
All right, that's going to be my next question.
And there are specific guidelines within each of those.
Okay.
I don't have the sheet in front of me, but
Got
if
you.
anybody has questions about that, please call me.
Yep,
and I'll
yep.
go through it with you.
Perfect.
My little shameless plug.
So there is income limit that you will so for say if I wanted to look it up, you would take a look at my income and tell me, and I'm sure the income limit might even vary by county maybe.
It does.
Okay,
and it
that's
also
what I figured.
and it also varies by housing size.
Okay,
By
gotcha.
family size.
Okay.
So if you have 1 to 2 people living in the home, it's X number of dollars, and then if you have 3 to 5, it's another.
Okay,
You get a little bit more leeway.
good to know.
But with those programs that West Virginia Housing Development Fund offers, they do have an option for a second note for those people that maybe don't have all the funds set aside for a down payment and closing costs.
Okay.
It is a second note that goes with it. It is a 2% loan. So I'm not quite sure where you're going to find a 2%
Yeah.
loan anywhere else.
Nah.
And it is amortized, so it's a fixed rate. And
Got you.
I believe it's for 10 years.
Okay.
And there's a certain amount that you can get based on the program that you use.
Right.
So for if you're putting for the home ownership plan, which is for first-time home buyers,
Mm-hmm.
if you are putting less than 90% down or less than 10% down, I'm sorry, I
Gotcha.
said
Yeah,
that
I know
wrong.
I knew what you meant.
If you're putting less than 10% down, you would be able to go up to $7,500, and then
Okay.
for more than 10% down, you can go up to $10,000
Okay.
in down payment assistance
Okay.
help, and that can go towards your down payment and towards closing costs.
Okay.
So theoretically, for a USDA buyer who's putting zero down because it's a USDA loan,
Right.
they could get up to $7,500 closing cost help
Hmm.
and then not have to ask for seller concessions,
Right.
which would make their offer
A lot
much more
stronger.
appealing.
A lot stronger. Good to know. Yeah, I think I got one of the buyers I'm working with now that I mentioned, the FHA 2 or 3K and whatnot with is working with a similar program, and they got money towards their closing costs that they're trying, so they don't have to put any money down.
Right. And we have a number of different products that we can do down payment assistance with, not just West Virginia Housing Development Fund. So Virginia, Pennsylvania, Maryland. I do have other options for those
Okay.
areas. So
Perfect. Perfect.
it's nice to have those options available to help out, borrowers that maybe have great credit but just have not been able to save up.
Yeah.
A perfect example, I had a couple here recently that we went through a broker channel for a down payment assistance loan.
Hmm.
Young kids expecting their first baby. And this was perfect for them because they both had steady jobs, great credit, but just had not been able to save up
Yeah.
and wanted to get out on their own and, have a place for their baby. And we were able to get it done.
Good. Well, good.
And
Glad.
they outside of having to pay off a debt, they didn't have any additional closing costs.
Very nice, very nice. Well, Miss Heather, thank you for coming through. I think you have shared a lot of various programs, a lot of options that a lot of buyers in the community in general that we don't know about. Like I learned a lot today too.
Oh,
So
good.
yeah, definitely. I mean, and I'm a realtor, so just learning those options that I can share with future clients that'll be able to help them is definitely good. But if somebody, as you mentioned, has some questions, they listen to this podcast and are like, hey, I want to find out more about whether it's West Virginia HUD or the one-time close construction, how can they find you or reach out to you?
Best way is to call or text me at 681-242-9967, or you can also email me at hadams@revolutionmortgage.com.
All
And
right.
I'm also on Facebook. So
There we go, Miss Heather Adams. Well, y'all heard it here first. Miss Heather Adams. Reach out to her if you have lending questions or want to inquire more about the different programs and options that she talked about today. And as always, if you're looking to buy, sell, or invest in real estate, I'm your guy, Gav the Realtor, on all social media, or 304-839-7040. Miss Heather, thanks for coming through.
thank you for having me.
Yes, ma'am. Everybody, y'all stay up and stay blessed. Peace.